Good morning, everybody, and welcome to our first ever UKBA conference. For those of you who haven't heard of UKBA, and I'm sure there may be a few of you present in that category, UKBA stands for UK Business Advisors, and I am David Shenkin, the chairman of the UKBA Scottish region. We are a group of business advisors who operate regionally from the north of Scotland all the way to the southwest of England. Each region, and in fact each individual within each region, operates autonomously. And each region is made up of individuals who have complementary skills. As a result, we can provide to our clients whatever skill set they need, even if we have to go to the relevant expert in another region to get it. However, what makes us different from other advisory organisations is the fact that we provide not just practical solutions, but very much hands-on solutions. Not for us the shiny proposals, the complex graphs, the fancy words. No, for us it's jackets off, sleeves rolled up, and we work alongside our clients to make our solutions happen. We work with all types of businesses to help them survive, to help them grow, to help them acquire, and to help them exit, whatever's necessary. Almost all of us have either run our own businesses or operated at a very senior level in business. And what we bring to every challenge is a wealth of experience, as we have seen good times and bad times, and have hopefully been able to thrive throughout all of these times. Today's conference reflects the challenges we are all currently facing. COVID has changed the way all of us think and behave, but it hasn't changed the fundamentals of good business. Our conference title is Plan to Thrive, Not Just Survive. Because in our view, what matters in today's very different environment is not just survival, although without survival, nothing else will matter, but how ultimately businesses can thrive as they move towards whatever the new norm will be. During today's conference, you will hear from the government and what they are trying to do to help business, from the UK's top restructuring body and one of their members, and they will then be followed by our panel of experts drawn from all over the UK and from very different sectors, who will try to answer your questions on how we can all succeed going forward. Before we start, can I give you a few housekeeping tips? We have muted everybody, and we'll obviously unmute the speakers as necessary. However, a key element of today's conference will be questions and answers. At the end of each speaker's presentation, we have allowed up to 10 minutes for questions. So if you wish to ask a question, can you please use the chat button and type your question and send it to me. Also with our panel, although we have a number of questions for them which have already been sent in, we still have room for more. I can't promise to use every one, but I will do my best to make sure as many as possible are asked and answered. We will be recording the session, and hopefully we'll post it on YouTube shortly after we finish, and we will distribute a link to it to all attendees. We are planning on a short break, 5 minutes or so, after our second speaker session finishes, approximately 11:10, just so that any of you who wish to catch up in emails or even make a coffee can do so. Finally, I would just like to return to the theme of our conference. Plan to thrive, not just survive. I know for many businesses how challenging the last 12 months have been and what changes they have had to make just to survive. What we wish today to be is a guide as to how to make that effort and sacrifice worthwhile. how you can plan to make your business even more successful so that ultimately you, your clients, and your customers can eventually reap the reward of that effort and sacrifice. I hope you enjoy your morning with us. Now I would like to ask one of my colleagues in UKDA, Raymond Lynn, to introduce our first speaker. Raymond.
Thanks, David. Hope you can all hear me. I'm delighted to be able to introduce our first speaker today, Colin Haig, particularly as in my previous life, had the opportunity of appointing him head of Baker Tilly's corporate recovery team, as it was known then. Colin joined initially the Insolvency Service as His Majesty's Government in 1979 and trained as an insolvency examiner. He was granted his insolvency license in 1989, and his experience includes being a partner at Neville Russell, aforementioned Baker Tilly, PwC, KPMG and BDO. He was appointed head of restructuring at Baker Tilly in 2002 and was then appointed president of the IPA in 2004. Colin has also held leadership roles at both PwC and KPMG and is currently, as David said, the president of R3. Colin's career, he's been involved in niche roles on larger restructuring deals. For example, he's involved in Johnson Press, Laura Ashley, Bell Pottinger, Carillion and British Steel. His specialist sectors are social housing, rail infrastructure and adult social care. Colin offers hands-on support to management teams at or following breach of banking covenants, and he's lead advisor to debt providers and elements of Her Majesty's Government. In his spare time, he's too old for this, but he enjoys skiing, motorbiking, and when he's fallen off both of them, then he can turn to jazz, which is another one of his loves. Colin, by the way, I want to wish you a happy birthday from yesterday, and I hope that COVID didn't interfere too much with your celebrations. Anyway, never shy to express an opinion. Can I now introduce you to Colin Haig as our first speaker?
Thanks, Ray. It's quite an intro, isn't it? Yeah, I really am that old. Morning, ladies and gentlemen. I hope you can hear me all right. So I'm joined today by Derek Forsyth, who's my partner out of the Scottish team. He's the heads up our London Scottish team up there. And between us, we're just going to give you a bit of perspective around what's going on in our world, which is in many respects quite seismic change, actually. So can I trouble you for the first slide, Rube, if that's all right? So Colin Haig, Derek Forsyth, that's the first slide. The next one, please. So Corporate Insolvency and Governance Act 2020, which has changed the landscape markedly. Look, one of my tasks as president of the UK Restructuring Association R3 is to comment upon the insolvency stats, and thus far, paradoxically, the stats have been lower than the previous year. And one might think, well, that means the economy is in great shape. Well, there are some challenges in the economy, we all know, which are largely driven, I think, by a pandemic that none of us saw coming. One of the things I often say to our members is, let's not try to apply pre-pandemic paradigms to post-pandemic problems. I think low numbers has been largely driven by the moratorium that the government has applied on corporate insolvency process and process generally, where applications to the court for winding up are based upon COVID events, and also to, let's say, the availability of COVID-related liquidity to COVID-related debts, C-bills, bounce back loans, what have you. So on the one hand, the court's shut, so they're not going to be winding up petitions. On the other hand, there's a lot of liquidity around there. So to put it mildly, there isn't exactly a burning platform. And that's why management broadly, I think, at this stage hasn't really taken, I think, much advice from people like me, although we're starting to see an uptick now. So government, I think, wisely pushed through a new piece of legislation. And in my experience, government got the consultation spot on this time. There was widespread discussion with people like me, lawyers, QCs, bankers, distressed PE, just about anyone that's got something to say around what the law should look like in this country. And SIGA is what we've ended up with. So there are some very important aspects from a restructuring perspective, which I'm going to take a quick canter through now. But there's also some, I would say, improvements to governance included in SIGA, which frankly I'm less interested in, but things like it's okay to hold virtual AGMs, you get a little bit of license around when you're filing docs. But the really seismic stuff is as follows. First of all, there is introduced a procedure called moratorium, where management can get a statutory stay of proceedings for 20 days, extendable by another 20 days in circumstances, which gives management some breathing space in which no one can bring legal process, and it's predicated upon management being able to convince an independent party, a monitor, who must be a licensed IP like myself or Derek, that there's a reasonable prospect of avoiding an insolvency. And we are very hopeful this will be a very useful piece of kit at all levels, not just for big ticket businesses, but for SMEs and mid-corporates too. The take-up so far has been relatively low, but I think, again, that's got a lot to do with the moratorium on compulsory process. But I think it gives great flexibility, and it gives the the potential and the optionality to make management much more, let's say, significant in the application of the solution than would have been possible under the old process, which was by and large, in the case of corporates, around CVA and administration. We'll touch upon some changes in that area too. The other, I think, really interesting development is that there is a new process introduced called the restructuring plan. And in some respects, the restructuring plan bears some resemblance to a scheme of arrangement, but in other important aspects, it's very different. So there's been lots of use of the CVA process, particularly in the retail space, to keep retailers afloat. And that has in some respects, I think, been quite controversial with the landlord community. And although it has been a good weapon to keep balance sheets and corporates intact, as opposed to moving the business on via pre-packaged sale of administration, in some respects, it's a process which has, alienated some important stakeholders, particularly landlords. So a process which is fresh and clean and has got a different approach, like the restructuring plan, is, from our perspective, I would say, very welcome. So we've seen Virgin use this plan, we've seen Deep Ocean use this plan. I think the Virgin Active Gym now are rumoured to be considering using a plan as an alternative to CVA. It's a really interesting bit of kit. And what makes it interesting is this. What you're looking to do, a bit like a scheme, is to get classes of creditors to approve the plan. But in the event that you've got a class of creditor that we say is in the money, that is in the value break, it stands to get a good economic outcome from the plan, and the judge is satisfied of that. And if, for instance, you've got a class of creditor that's objecting to the plan who's out of the money, there is the potential for what's known in the trade as cross-class cram down, quite a mouthful. But what it means is that you can use relevant financial stakeholders to cram down less relevant financial stakeholders to force the plan through. And this will be done with a high standard of proof, a very high scrutiny of the judge. But on the day, the judge will make a decision as to whether or not the plan is live. So we think this is a really interesting development. Unlike a CVA, where potentially you've got 28 days challenge risk, where everyone's sitting around wringing their hands worrying about whether or not the CVA is actually going to fly. When the judge makes his decision, the plan is live. So we're hoping that this is going to be a really useful bit of kit in keeping corporates intact, in giving management an opportunity to really express their opinion, be part of the solution, and to do some much more imaginative things than, frankly, we've been able to do hitherto. Although the pre-pack, and I'll allow Derek to talk to us a little bit about that, I think will continue to be a very useful bit of kit, where you moratorium or restructuring plan, or indeed a CVA, or you know, frankly, there is some question about whether or not it's going to be possible to preserve the entity. A pre-pack will give us some interesting optionality. Derek, can I ask you to take us through the pre-pack?
Yep, thanks, Colin. Ruby, if you could maybe flick forward, I think 2 slides, please. Thank you. So pre-packs, as most of you will know, are a valuable tool to restructure viable companies, essentially involving the sale of either a business or part of a business, whereby the sale is arranged before the administrator is appointed. And that can either be to a connected party or to an unconnected party. The administrator is then appointed, sells the business 5 minutes after he's appointed, and the new business carries on. As I say, a valuable tool. I think there has been a lack of public confidence in the whole process over a number of years now. This results from probably creditors just seeing a company effectively continuing to trade with the same people in charge, but with the debts wiped clean. There have been a number of, I suppose, methods of trying to make that a cleaner process over the years. The Graham report came out, and up till now, the process has been regulated by SIP 16, which essentially is an insolvency guideline, which looks at putting the onus on the insolvency practitioner to effectively cleanse and justify the procedure. Pre-packs, I think, do work well. They are a valuable tool, and the profession has been trying to overcome the bad press around that over the last few years. This has culminated now in some new legislation coming out. It's been passed and is likely to be introduced in May 2021. And it covers the situation where there's a disposal through an administration process of either all or a substantial part of the company's assets to a connected party. And in those circumstances, the new legislation provides that the administrator will be unable to dispose of the assets to a person or a party connected with the previous company within the first 8 weeks of the administration, without either, firstly, the approval of the creditors, or secondly, an independent written opinion. And it's the connected party who will require to obtain the written opinion, which is an interesting development. So the guidelines suggest that the provider of the opinion must be independent of the connected party, obviously, and must meet the requirements as to the qualifications and experience required. The written report is to be provided stating the case either for or against the disposal, and the connected party purchaser may actually obtain more than one report. Where the report states that the case is not made for the disposal, the administrator may still proceed with that, but in those circumstances he'll require to state the reasons for doing so. And just to formalise the process, the administrator will require to send a copy of the independent report to both the creditors and file it at Companies House. So quite a move forward, I think, on the whole pre-pack transparency process. Obviously, option A is to obtain the approval of creditors, and that would either be done pre-appointment by the company and the administrator-elect, or immediately post-appointment. I suppose the risk is beforehand, if the administrator tries to do it, or the company tries to do it beforehand, the creditors may take their own action, although a moratorium may provide against that. And if he tries to do it post-appointment, obviously the administrator takes the risk of having to run the company on for a while whilst creditor approval is sought, and that may not come quickly enough for him if the business is losing money and he isn't able to fund ongoing trading. The option of obtaining the report, the independent report, one or two issues, I guess, initial thoughts coming out of that. The opinion provider doesn't need to be part of a regulated profession. So I think it would be ordinarily the case that we would expect such an opinion provider to be another insolvency practitioner, a chartered accountant, a solicitor, etc. He need not be. And I suppose the other issue coming out of that is that the purchaser chooses the opinion provider. That maybe gives the purchaser a bit of an option to opinion shop and search around until they get somebody that he thinks is suitable rather than somebody who necessarily will be suitable. So it'll be interesting to see how this plays out. The onus is very much still on the insolvency practitioner to account to the creditors with a kind of belt and braces approach. And the easiest thing in those circumstances would just be to get the creditor's consent. There will be areas of concern and challenge, I think, around the independent report. So it'll be interesting to see how that plays out, because I think, as Colin said, we do anticipate a number of pre-packs going forward. It is a way of preserving what will be a viable business, and effectively just getting rid of the debt. And in a number of circumstances for banks and secured creditors, pre-packs will represent the best way of ensuring that survival of the business and getting value going forward.
Yep, I agree. I suppose
Next
the marked
slide,
difference, marked difference, Derek, is up until now the onus, as you say, to make the application to the pre-pack pool, the predecessor of the evaluator, has been on the purchaser, but also it's been optional, isn't it? There's no obligation to do it, whereas it will be obligatory. Sorry to interrupt.
Okay, next slide, please, Ruby. I'd like to look at just quickly now the reintroduction of HMRC preferential claims. I guess some of you in our virtual room might be old enough to remember when HMRC claims for VAT, pay-as-you-earn and national insurance were preferential. That was up to 2003. However, the Enterprise Act in 2003 created circumstances whereby they were then relegated down to the status of ordinary creditors' claims. The idea behind that to try and give a greater prospect of return to the ordinary creditors. Legislation introduced, and I would have to say rather quietly, in December 2020, reintroduced HMRC as a preferential creditor in all insolvency appointments starting from the 1st of December 2020. So from that date, they will be treated as a preferential creditor, albeit a secondary preferential creditor, such that they'll rank behind employee arrears for wages and holiday pay. The new preferential claim will cover collected taxes only, so that would be VAT, pay-as-you-earn and employers' national insurance, but it won't cover employers' national insurance and also not corporation tax. Interestingly, there'll be no limit on timescales or arrears or amount for any of these debts. Previously, it was either 6 months or 12 months, so HMRC can go back and throw the kitchen sink at their claims and include pretty much anything they want without time or limit. These claims will rank ahead of floating charge creditors from 1st December 2020. Shouldn't affect the right of fixed charge creditors whose security will still rank ahead of the preferential creditors. But I know a number of you on the course today are advising Scottish companies where obviously the floating charge is more relevant than down south. Be interesting to see how this plays out as well. I mean, I think in a number of employee-intensive companies who go into an insolvency process, the HMRC claims will be very high for pay-as-you-earn and national insurance. I think with all the deferrals that have happened over the last 12 months or so, most companies are carrying a much higher HMRC liability now than they ordinarily would be. So it could have quite an impact. And just in terms of the stakeholders, looking firstly at HMRC, all else being equal, they will, as I said, have a greater debt, and it just remains to be seen how that will shape their recovery tactics going forward. They were quite an aggressive creditor beforehand. Whether they will come back and continue to be remains to be seen. Looking at the floating charge creditors, I think, again, all else being equal, the banks will lose out on this and get a lesser recovery going forward. And it'll be interesting to see how that shapes their lending policies going forward. I think their credit committees always say that they don't anticipate any recovery under the floating charge assets, but I suspect they do actually. There will be less money for the ordinary creditors. And one interesting aspect of this will be there will probably, all else being equal, be a greater liability potentially for personal guarantors. So if any of your clients have personal guarantees, either to banks or to secondary lenders such as, I guess, Funding Circle or IWOCA or any of these guys, the impact of the increased preferential claims will largely give a lesser recovery to these parties, and therefore, if there are personal guarantees in place, an increased responsibility and liability to any of your directors who may carry personal guarantees. Next slide, please. So I guess up to now, the theme of today's conference is Survive and Thrive. Up to now, Colin and I have covered the likely impact of the new legislation. And I guess what we'd like to do is sort of stand back from that a little bit and now just provide some more general advice to stakeholders and share this with you as their advisors as we look to come out of COVID, hopefully. Let's also not forget the impact of Brexit. Colin has a great phrase where there's a vaccine for COVID, there isn't a vaccine currently for Brexit, and those issues still be there. So, it's pretty tough times for businesses just now. And very many of them will be concerned about their ability to come out, survive and come out of the other side. And this is a time really when stakeholders really need to proactively manage their businesses more than ever and not just bury their head in the sand and blame COVID, Brexit, Boris, Nicola or whoever. So just in the few minutes we've got left, I'd just like to share some, offer some advice and share some of our experiences that we built up over the years on how best to provide businesses. This would effectively ordinarily be a presentation on its own, but I think it's important just to cover some of the key issues whilst we're on the call today. So firstly, it goes without saying the importance of liquidity. Cash is and always will be king. We can't overemphasize that. In our experience, businesses with cash reserves have a far better chance of surviving a downturn than those who don't. Having a few quid in the bank, I think, takes pressure off having to make immediate decisions, offers a degree of control and buys breathing space to look at all other options. On the predatory side, it also gives those businesses with cash an opportunity to take advantage of other businesses who might be struggling and to buy up smaller businesses or assets in these times. First issue to look at just quickly is projections and working capital management. I guess for most businesses, things are changing at least monthly, and it's never been more important to continually forecast ahead and engage in strong working capital management. Most businesses really have been kept going by the CBIL and bank, the bounce back loans over the last 12 months. But then that new funding is limited, it's starting to run out, and it will soon be time to start repaying all the debts. So it's imperative that stakeholders know what their businesses are able to operate within. Can they do that within the existing banking facilities, or if not, they need to have a very strong look at how they can fund that and reschedule their debts going forward. There's no prize for ignoring this. We are constantly astounded at how reasonable sized businesses don't project forward and anticipate all of this, and really the price for that is simply running out of money, and then there are no options available. So on the working capital management side, essential to try and get some money out of the debtors, really push them hard, liquidate any surplus assets that you've got, get the cash in the bank, and reschedule creditors where you can, essentially just to defer the outgoing cash over the next few months or so until we're back in harness again. On the creditor scheduling side, I think that's something companies have got used to over the last 12 months or so, as have creditors themselves. I guess if we look at the main stakeholders, HMRC have a well-publicised deferral arrangement system in place. I think the issue with that is nobody really knows how long that's going to go on for, and what HMRC's attitude will be as we come out of COVID. Will it come to a cliff edge, or will we have a phased coming out of COVID, such that HMRC work with companies. Likewise, banks and funders, most of them have offered loan repayment holidays over much of the last 12 months, but that's all now coming to an end, and companies now have to address how they'll start to repay these debts. Likewise with trade creditors, the enforcement, as Colin said, creditors aren't allowed to enforce just now, but that will change and they will be able to do that. So it's important that arrangements are made to reschedule creditors, but also to continue getting supplies in from key suppliers. And last but not least, landlords. For those businesses leasing premises, typically landlords have granted payment holidays over the last few months. They are generally in probably a weaker position just now. The last thing they want is their property back with all the attendant costs and liabilities, etc., and probably a lack of ability to re-let the premises. So there certainly are deals to be done with landlords at the moment. So I think it's important really to do the projections and then to work out who you can pay and come to a plan really with all your creditors to do that, such that all are treated as equally as possible. There will be some pressing creditors, as we said, who will need to be paid, and so there can be some flexing around that. But it's important that a plan is in place to address all creditors going forward, and not just the ones that shout the loudest. On the cost and profitability review, I don't think in terms of speaking to you guys today, we need to give any advice on continuing cost reviews. I guess that's where we're all fairly strong in teaching our granny to suck eggs. But I think one of the things companies must be very strong on is profitability review. Costs will be cut and can be cut, but really unless companies are trading either break even at best or profitably, if we're trading at a loss, all that will happen is debts will build up over a period of time. So all steps must be taken to cut costs and to at least get back to a profitability situation. That would involve companies looking at the various parts and divisions of their businesses, looking at what's making money, what's not making money, evaluating the relative contributions of each, and making some harsh decisions around cutting costs. This is a time to make harsh decisions. It's not a time to put things off. So, you know, if you've got clients who are losing money, the costs are too high, they've got too many family members in the business or whatever, then they really need to look and make some harsh decisions about cutting costs and getting back to profitability. Last but not least, it's imperative that companies have a good relationship with their funders and their banks, and keeping the banks on side in this. It's all too tempting to say, hey guys, we've had a bad month, don't tell the bank, and to stop returning the bank's calls and stop providing the bank with MI. But it's never been more important that that is carried on through and that customers engage with the banks. The banks largely will agree a strategy with directors and work with directors to try and come through all of this. So I can't emphasize the importance of going with that and continuing good relationships with funders. Next slide, please. So that really takes us through
script.
Yeah, our script. I hope the last 20 minutes or so have provided a quick summary of the legislation and our advice generally. I guess there will be times when companies will go through, times when it will be more difficult to carry through that. And I can only suggest that the earlier advice is taken if a company is not sure of its solvency or what restructuring options are available, just to take advice from an insolvency professional. There are plenty of options there, and I think as a profession we'd be delighted to help. Thank you.
We've got 10 minutes for questions, if that's all right, David.
Probably slightly less than 10 because our next speaker is now with us, but I do have a couple of questions that have been fired to me. One of them is, do you think that with the introduction of the moratorium, or what I would call a coming off period, do you think we're moving towards a scenario where, like the American type Chapter 11, the stigma of insolvency will matter much less than the preservation of a trading entity?
That's a really interesting question. It's certainly true that if you look at, the constituency of lawyers, particularly in the City of London these days, there are lots and lots and lots of American firms who have a very strong, foundation in Chapter 11 and have a voice about, how we ought to be doing things in this country. I'm a pragmatist, basically. I don't care whether or not it's invented in America, if Germany, wherever, Mars. If it's a useful bit of kit, I'm going to use it. We're in a situation where we've got competent management teams who've done nothing wrong, nicked any money, haven't breached covenant, just happened to be on the board when the pandemic arrived. And therefore, if we can buy them some air cover, then give them some think time, a little bit of respite in which they can come up with a sensible solution and consult with the stakeholders as appropriate, then that's fair game as far as I'm concerned, and that's what the moratorium has potential to do. And it may not cost an arm and a leg. I mean, the burden on the monitor to make certain they're actually doing what they're supposed to do is quite high, and there needs to be some risk management there. But it should give good management teams some important airtime, David, to do what they probably couldn't have done under the old law.
And I suppose as a follow-up to that, the new scenario whereby you've discussed the 8-week scenario and the independent written opinion probably as being the methodology that's going to be required to allow a pre-pack to happen. Isn't there a danger that somewhere within the 8-week situation, if we get to the stage where a business is actually viable, but loses the opportunity to create a new structure because of the fact that it is stuck, unable to move, even if you've used the moratorium, because the moratorium effectively will cover initially the first 4 weeks of it. And I suspect that if businesses are having to wait 8 weeks plus before the potential of a sale to a connected party, does that not risk the fact that we're going to lose successful businesses?
Well, it's about 3 questions there. I'll have a go. Derek, back me up, please.
Yep.
Around the pre-pack point, look, I'm hoping that, you know, with the optionality of the restructuring plan and the moratorium, we may not need to default to a pre-pack quite like we used to. It gives us some important optionality, right? So first of all, if we can keep the business, the balance sheet, the capital management, the entity, the covenant intact via a plan, great. I think that that's going to be a really useful option for us that we haven't had probably in going under old law. As regards, you know, pre-pack, personally, I'm not massively impressed by the evaluator idea. I like the pre-pack pool. I think they did a good job. What was wrong with the pool was that applications to it weren't obligatory. So we're now in a situation where the application will be obligatory. Gold standard, well done HMG, you get a tick for that. But we're in a situation where somebody relatively unqualified, the only obligation at the moment, this might change when it goes through the Lords, but the only obligation is to have a PI policy. Not much of an obligation, in my view, is going to be the arbiter on whether or not it's a good or bad pre-pack. That doesn't sound like the progress I was hoping for. I'll shut up, Derek, while you have a go.
Yeah, I think that's the main concern on the pre-pack side. I suppose the lack of guidance around who may be. Well, firstly, it's the purchaser that chooses the independent report provider, and secondly, the experience around that. Pre-packs are quite specialised, and IPs effectively are going to have to account for a report that's been prepared by someone else, who they really have no control over. So I think that's the obvious flaw in the argument, I think, there.
Guys, I think we'll probably call it at that, if you don't mind. That's been really useful. I suppose we've started by looking at what happens when things really go wrong, and I think the rest of the morning probably is going to be, well, let's try and see what can be done so that things don't go wrong. Not that I want to put insolvency petitioners out of business, but ideally we'd be in a situation where the requirements for you would become less and less. But thanks very much for giving us an insight into the world of restructuring.
Yeah, you're very welcome, David. If anyone has got any burning questions, they're absolutely free to mail Derek or I at Azets, and we'll go straight back to them.
Yeah, and just to mention, at the end of the conference, we'll actually have a lot of contact details on the screen, including contact details for Colin and Derek. Okay, thank you very much. I'd now like to move on to our next speaker, and I would like one of my other colleagues in the UKB Scotland, Kenny McCreary, to introduce our next speaker. Kenny, thank you.
Kenny will make a label for it. It's just a flower. No, it's okay. Yeah.
Thanks. Thanks, David.
Ruby, can you mute whoever's still speaking?
Yeah, it's okay. I'm good. This fucking thing's playing up.
Sorry to interrupt you, Kenny, but there seem to be 1 or 2 people speaking in the background.
All right.
I think it was Graham Noble, but I recognise his voice. Okay, Kenny, can I come back to you? Sorry about that.
No problem. Thanks, David. And good morning, everyone. Our next speaker was brought up in Hamilton, attended Hutchinson Grammar in Glasgow before studying politics at Exeter University and then becoming an accountant with Coopers and Lybrand. He has also worked as an associate in executive recruitment with Odgers and Bernstein. In 2010, he was elected as Conservative MP for Milton Keynes, a seat he holds to the present day. He has held various senior positions in government and is currently Parliamentary Under Secretary of State for Scotland. Please welcome Iain Stewart, MP.
Thank you very much, Kenny, and good morning, everyone. It's a great pleasure to join you this morning. I'm speaking to you from my office in Dover House on Whitehall, which is the Scottish office in London. What I hope to do over the next 15 minutes or so is just give you a short overview of my career to date, and then talk about some of the budget measures that were announced last week. And then we'll have time for plenty of time for questions, on which you can ask me about absolutely anything you want, from what I talk about in the budget and politics generally, right up to my views on Rangers and whatever else is of interest to you. As Kenny said, although I represent a Milton Keynes seat in Parliament, I hail from Scotland. I grew up in Hamilton, went to school at Hutchie, and my first forays into politics were in Scotland. My first seat I contested was in the first Scottish Parliament elections in Rutherglen. I wasn't successful then, which probably doesn't come as a surprise to anyone. It always amuses me that one of the polling areas in the Rutherglen seat is called Tory Glen. And when I saw the Tory Glen box open at the election count, I didn't see that many papers, ballot papers with a cross next to my name. And I also spent a good bit of time working for the party in Scotland, and I was an advisor to our shadow team in Westminster when the first Devolution Act went through Parliament in the late 1990s. And after being elected in 2010, I kept a very keen interest in Scottish politics. I worked for a time as Parliamentary Secretary to David Mundell when the second Major Scotland Act went through in 2016, which, as I'm sure you know, devolved further considerable powers on tax and welfare and a number of other areas to the Scottish Parliament. I was asked to join the government in the summer of 2018 in the Government Whip's office, which, given that we were in the midst of all the Brexit psychodrama, if I can put it that way, in Parliament, with no government parliamentary majority, was a very interesting time. And it fell to me on a number of occasions to be one of the tellers, who are the whips from either side of the House, who count all the votes and then announce them in front of the Speaker at the conclusion of the vote, which, given the key nature of many of the votes, was quite a daunting progress, given that the chamber was packed, the television cameras were on you live, and you may know that you can always tell which side of a vote has won by where the whips position themselves in front of the Speaker's chair. And I was told that a number of financial services companies employed people to advise them as to who were the government whips and who were the opposition whips, so that they could get a head start of a few seconds on which way a Brexit vote had gone, in case it affected the market. So I suppose that's some small share of fame or notoriety, depending on which way you look at it. And I did that job in the Whip's office for approximately 2 years. And then last June, I was asked by the Prime Minister to join the Alistair Jack as Secretary of State for Scotland as his junior minister here in the Scottish office, where I cover quite a wide range of portfolios, from the City Deal programme, which is our investment together with the Scottish Government in investment programmes for Scotland's cities, broader city regions and rural areas. I'll cover some of the higher education portfolio, transport, business and the economy generally. So quite a wide-ranging portfolio, and it's been a fascinating journey over the last 9 months or so. Clearly having to come in at the time when there were all the challenges of COVID, both in the health aspects of it, but also supporting businesses through the immediate challenges and looking at how they can bounce back once we are through those measures. Obviously, we were in the run-up to the whole Brexit future trade arrangements, which went, as you know, went right down to the wire and made for some interesting days in the office, preparing for all eventualities. There's a broader Scottish constitutional issue, which I won't touch on now, but if you want to ask me about that in the Q&A session, I'm very happy to do so. And now that we have our roadmap, we have the vaccination programme, we are hopefully seeing the light at the end of the tunnel. And I'll now just touch on a few aspects of the budget that the Chancellor announced last week. It was, as you probably saw, there were 3 central themes to the budget. The first one being the continuation of the support for business, for employees, and for families generally, with the extension of schemes like furlough and the self-employed support scheme, the universal credit uplift, and a number of other measures through to September. And that timetable was quite carefully arrived at. The roadmap that we have, certainly south of the border, and the Scottish Government's one is not vastly different in terms of its timescales, is a cautious one. Each phase of the relaxing of restrictions, which in England started at the beginning of this week with the reopening of all schools, is deliberately designed with pauses in it, so that should there be an uplift in infection rates, we've got time to pause later stages and make sure that we don't unlock too early in a way that just puts us at great risk of going back into lockdown in the near future, which I don't think is in anyone's interest. And those relaxations will continue at 4 or 5 week intervals through April and May and into June, with a view to them being, pretty much fully lifted, albeit with perhaps still some social distancing requirements by mid to late June. But we've designed the extension of the schemes to September just to give that breathing space in case some of the measures have to be extended if there was an upturn in infections, but also not just to withdraw them too quickly, so that just at the point we hope businesses are getting back on their feet. And I believe that there is a vast amount of pent-up demand in the economy. That those measures are there to support them in those initial weeks and months. But obviously the Chancellor will keep that under review, and should we be blown off track by some unforeseen variation, mutation of the virus or something else like that, I think the Chancellor has demonstrated throughout that he's willing to adjust in the light of reality. In addition to those general measures, some specific sectors, of course, who are at the sharp end, particularly the tourism and hospitality, there'll be a range of measures that continue beyond September, with reductions in VAT, and business rates are devolved. There's a slightly different scheme in Scotland and England, but again, for that sector, there'll be that further support and a range of other matters. And we've also been looking at a number of moving on to the second phase of the budget, and that's how to encourage investment and growth in the economy that will help bounce back. And again, I can go into some of the specific schemes in detail, but incentives like the super deduction to encourage investment in plant and machinery and other assets is there to help encourage the investment in the future of the economy. We brought forward, as I mentioned in my introduction, I'm responsible for the City Deal programme, and that a number of those programmes which were designed to be over a 15-year period, we've brought forward to a 10-year period, which means more can be invested at an earlier stage. And sitting alongside those city deals, you've probably heard referenced a number of the other public investment ideas, like the Levelling Up Fund, like the successor scheme to the EU structural funds. And although each scheme is different in its quantum and eligibility, they all share a common purpose, and that is it's about incentivizing local areas to come up with the investments that they think are of best value to the local area. And what we're seeing with a good number of the City Deal areas, particularly the ones like in Glasgow, Edinburgh and Aberdeen, where they were the first ones to be introduced. They've developed, from what I can see, is a very mature and sensible network that isn't just public sector, be that local authority, Scottish Government or UK Government, but actually drawing in the universities and other research and development institutions like the catapults, and with the business community in those areas, so that they can spot where a particular intervention can help leverage in wider investment. And to give you one practical example of that, in the Glasgow deal, as part of the UK government investment, we funded the redevelopment of the area at Tradeston on the bank of the Clyde in the centre of town. And it was that investment that helped facilitate the Barclays Bank's investment in their new base there, which will create, I can't remember the exact number of jobs, but will be a fairly significant new employer in the centre of town. So that's the approach we want to take. We want to encourage local areas to come forward with those both capital and resource funding bids, so that we can help support the rebuilding after the pandemic, and also give an opportunity for them to consider some of the potentially permanent changes that the pandemic has brought about. We don't know at this stage, for example, what the new normal will be in terms of patterns of work. Are we moving largely back to an office-based system, or are we going to have a more blended approach with people working at home some of the week and in the office the rest of the time? I think I read British BP announcing a 3-2 split between office and home working as a fairly permanent move. And of course, that then has big implications on the economies of large town and city centres. What does it mean for commercial real estate? What does it mean for the retail economy there, if you're not having the same numbers or a permanent presence of employees in those offices in the city? What does it mean for our transport network, which is primarily designed to carry large numbers of people from home to office in the morning and back home in the evening rush hour? So, there are big implications from COVID that we don't fully know the answers to yet. But we want to create that flexibility so that local areas are well positioned to respond to it. The final area of the budget was obviously keeping one eye on the public finances. The amount that COVID is costing us is an eye-watering sum, north of 400 billion. Now, we're in the relatively comfortable position at the moment that debt is fairly cheap, it's serviceable. We started from a point where our public finances were in a relatively healthy state, but we can't assume that that will continue. So I think it was right for the Chancellor to signal initial measures about how we're going to get some balance restored in the public finances. We're clearly still in a fluid moment. We've only got predictions as to what the growth will be. If it's better than anticipated, then that obviously reduces the need for some tax measures in the future. So I think we've set the direction of travel, but there's still some flexibility built in to make sure that we support business, we encourage investment as we emerge from the pandemic. I just want to touch in the last couple of minutes of my speech on one or two other areas which I think may be of interest to you, and then we'll hand over to questions. The first is in supporting exporters in terms of either those who wish to start exporting or those who wish to scale up. In Edinburgh, we have a new UK government office set up in just down from Waverley Station, Queen Elizabeth House. Now, that's not just a fancy new office for the Secretary of State and I when we're in Edinburgh, but it's a base for all UK government departments. And in particular, the International Trade Department is setting up a dedicated Scottish export hub there. And we'll be networking and meeting Scottish businesses of all sizes to give them the weight of their knowledge and expertise in how to identify and navigate new trade markets around the world, and particularly those countries where we already have or are in the process of signing new free trade deals. We've already got countries like Japan agreed, which go much further than the EU deal, that the trade deal that the EU had with Japan. There are others under negotiation with, for example, Australia, New Zealand, and the United States, and there will be many more to come. And finally, I just wanted to, talking about the US, I think a significant development over the last week or so has been, how can I put it, as a cessation of hostilities in terms of tariffs and trade. This all stems back to the Boeing-Airbus dispute, which has been rumbling on for almost 20 years now, and led to the punitive imposition of tariffs on products like Scotch whisky, which was having a significant detrimental effect on the industry. We took the bold, and we were criticised for it, but the bold step to unilaterally suspend our tariffs on US goods. This was in the dying days of the Trump administration. We weren't able to secure that before he left office. Perhaps he had other matters on his mind at that point. But I'm very pleased that those discussions continued with the new Biden administration. And last week, the US announced that they were also suspending their tariffs for a good period of time, which will give us a space to resolve this matter permanently. So thank you very much for your attention, ladies and gentlemen. I've covered quite a number of topics over the last 15-20 minutes or so. But I very much look forward to hearing your questions on what I've been talking about, or indeed any other subject that's of interest to you. Thank you very much.
Thank you very much, Minister. Yes, and it might well be fascinating to hear your thoughts on Rangers. I know you mentioned that earlier on, but perhaps before we move to that, or if we get round to that, there are maybe a few other questions that I would like to put to you. One of them is, you refer to the fact that the government support for business has been deliberately targeted to extend out till September, albeit there's every likelihood that we will see signs of recovery far before then. I think we're starting to see a little bit of it just now. But obviously the last thing that business wants is potential of support falling off a cliff edge. And one of the areas which I would like to mention, it was touched on in the initial speaker's presentation, is the attitude and position of HMRC. Because what's become very clear in the last 12 months is that HMRC have been a significant supporter of businesses. Their attitude towards businesses looking for help in terms of time to pay arrangements and everything else has been very different from what it was pre-pandemic. Pre-pandemic, their attitude generally was, why should we help? It's our money, we're entitled to it. Post-pandemic, it's been, what can we possibly do to help? And that change in attitude obviously is coming from the Treasury and the government. How long can we rely on that type of support continuing?
Well, an excellent question. I think for the considerable future, because the general attitude is there's no point having spent this vast amount of money keeping businesses afloat, keeping jobs open, having spent all that money just to close it down too quickly when business gets going. So I think that is a general attitude across government, that we want to help businesses ease back in to a return to normality. And even if you look at the schemes like furlough, it's not just it comes to an end, but there will be a gradual tapering of it. It also, different to how it was first introduced, there is a flexibility within it in terms of it will still support a part-time return to work. So if there's not enough activity for an employee to return full-time, there is, as I say, a flexibility in the system to to allow them to work a number of hours and then be supported for the rest. And the budget also contains measures like pay to grow. I forget the title, but basically you pay as you grow. That's the title I'm looking for. And not in the budget, but at the back end of last year, there were more generous and flexible repayment terms announced for the CBIL scheme and related ones, which allowed a much longer repayment term. So, I mean, I'm always happy if members on the call have specific queries for HMRC that we can help get answers to. Very happy to do that. But I think the general attitude, as I say, is not to, pull out the stamp straight away and give that support. The Treasury, the HMRC is there, of course, to make sure that the government gets the money, and the more of that we can collect through the existing schemes alleviates the need for new tax measures later. So they won't be completely benign, but I hope there's, I genuinely think there is that sort of helpful attitude to allow, reasonable, fluctuations and allowances for businesses who are struggling to get back going.
Okay, right. I have another one for you. Because these are not just my questions, I'm just acting as the funnel here, but there's no doubt that reskilling people will quickly become a priority as we transform as an economy. What generally do you think the government can do to actually tackle that challenge?
Well, it's another really good question, and there are going to be. There's a need for skilling up and reskilling in many areas of the workforce. And in terms, particularly looking at those who are currently unemployed or being threatened with unemployment, there's a mix of UK government and Scottish government packages there. From the UK side, there's a scheme like Kickstart, the measures in the budget to encourage apprenticeships. And through Sandy Begbie, who's helped the government with their Young Persons Guarantee, the Scottish Government, the Young Persons Guarantee. There's a suite of measures there. And I've been in regular touch with Sandy, and his clear view is, and mine, is that whether it's a UK government initiative or a Scottish government initiative, either the business or the individual doesn't see the wires behind it. They just see a suite of options and can choose which one is best, is most appropriate for their circumstances, and all the organisation happens behind that. The other more general point I would make is, one of the outcomes from this pandemic is an acceleration of changes in the economy that were happening anyway. Greater automation, the need for better digital connectivity, the investment in the green economy. That is all stepping up a gear. And that is something we do need to increase our skilled workforce in all these areas. So you will be seeing over the months and years ahead much more investment in that side of things.
Okay. We've been very successful in the UK, I think, in rolling out the vaccination programme. Not only that, but there seems to be a far greater demand in the UK for the vaccine. That position has not been replicated throughout Europe, and certainly throughout various other places throughout the world. Do you think that the lack of vaccinations elsewhere ultimately is going to make trading with the likes of European countries and some of our other trading partners far more difficult in the short term?
Well, in the short term, yes, because it will, I think, until other countries get up to a reasonable level of vaccination, it is going to make international travel and distribution more challenging. Not impossible, but more challenging. And that's not just the case with the EU, it's right around the world. And that's one of the reasons why the UK has been a leading participant in the COVAX scheme, which is to help share vaccines around the world. There are still debates going on at the moment about whether we should have a vaccine passport type of arrangement. So those who have had the jab, together with whatever testing is appropriate, will allow you to travel. It's a little too early in the journey for that, but those discussions, which throw up all manner of unintended questions and moral issues about freedom to travel and everything else, those all have to be worked through carefully. But the other point is, and I think Iain Vallance, the chief scientist, made this point the other day, we're not going to be COVID free. It's something that we're going to have to learn to live with. And although flu is a completely different thing from COVID, we do tolerate that risk that in normal times that a percentage of people are going to get a potentially fatal strain of flu. And that's something that we're, I say, just going to have to accept as a risk at some point. So as I say, we're I'm not saying we're the best, but we're one of the leading countries in getting the vaccines out, and it's imperative that we help other countries do so as well.
And I think I'm going to finish with a very simple one. Can Scotland afford independence?
Well, my answer is no. But just to caveat that, could Scotland be an independent country? Of course it could. But would it be as well off, both financially and in terms of the sort of shared ambitions, the strength of the Union, the strength of our armed forces, the fact that we have so many cultural, family and every other tie you can imagine? Would we be as well off? No, I don't think we would. So I'm afraid I'm a firm unionist and always have been.
Minister, thank you very much. I think that just about brings us to the right time. We really do appreciate you having come along this morning. It's been really interesting, and certainly from the perspective of my organisation and business advisors, you know, we are very, very welcoming of the government support that generally is helping our clients move forward. And the key that message, I think, coming back to my first question, we need that support to carry on for as long as possible, because other than that, it's hard to forecast how we can plan to thrive as opposed to just survive. Yeah. But thank you very much, and we do appreciate it.
Been a pleasure. Thank you.
We now, I think, have got a 5-minute break just so that everybody can recharge the batteries or pour a cup of coffee, and then we should be able to restart with our panelists at 11:20.